I believe if you have a deal that you can maybe buy below market value, you can add value and you can refinance to take all of your money out, then actually really should you be doing a joint venture where you're giving away 50% of the cash flow and 50% of the equity, even though they've had their money back. I see a lot of investors, and a lot of them do loans, but the majority do joint ventures. And I think the reason why is because people think, well, hey, I've got a potential deal here, I've exhausted my own funds, and I'd rather have 50% of the deal rather than having nothing. And so I completely get that. And sometimes a joint venture is the right thing to do, not just for the money, but also sometimes the experience and knowledge that other person might bring to the table. So there are lots of great reasons for doing JVs, and it kind of makes a lot of sense. Or does it, from a financial point of view? And as I said, sometimes there are reasons why you should not do joint ventures. Let me say that again. Sometimes you should not be doing joint ventures. So for example, I believe if you have a deal that you can maybe buy below market value, you can add value and you can refinance to take all of your money out, then actually really should you be doing a joint venture where you're giving away 50% of the cash flow and 50% of the equity, even though they've had their money back. So that's going to cost you a huge amount of money. And I think the problem is most investors, they start by doing joint ventures because maybe they don't quite believe that people would lend the money, or maybe they don't think they know anyone who's got money. And so they think they have to give more. And they think, well, by giving half of the profits and by giving half of the equity, I'll find more people who I can do deals with. And if it's a good deal, there are definitely people who will come in and work with you on that basis. And I think investors get used to doing that and they get a bit lazy. In our minds, I think it feels like more work to go and get a private lender, because after all, well, they're only getting a percentage interest. Are they really going to be happy with that? And some people you speak to, they're not happy with that. They want to get a slice of the cake, they want a piece of the equity, but they need to understand that there is an element of risk as well, and they're taking some of the risk on if they're doing a joint venture. Whereas a loan, there's always a risk on anything, but theoretically, it's less risk than a joint venture. So what I want to do is demonstrate to you just how much a joint venture can cost you. Now, please listen to what I'm saying, in that joint ventures can be great in many circumstances. And I think it's worth doing a few just to understand that. But I think a natural progression is from joint venture onto private loan. And I just want you to realize just how much a joint venture might actually be costing you. So let's make up a theoretical example. You could fill in the numbers in your workbook here. Let's say you buy a property below market value for £160,000. Let's say, 150,000, sorry. And then you're going to spend £60,000 turning it into a 6-bed licensed HMO. I think that's on the light side, but let's say you've got some good contacts and it's pretty good. You're not doing too much to it, but you're turning it into this 6-bed HMO. And so when you've done this work, let's say the value of this property is £300,000. Okay, so you bought below market value, you've spent 60k on it, and you've increased the value up to 300,000. So kind of believable numbers. Now, if you were going to refinance that property at 70% loan to value, which is, I've used that because that's often a commercial rate that people use, you'd get a mortgage of 210,000, which means you'd get all of your money out. So you bought for 150, you spent 60, so it's cost you 210. You increase the value to 300 and you get the value on the new higher value, you get the mortgage on the new higher value. 70% of 300 is 110. So in other words, you get back all the purchase money, the deposit, the mortgage, and all the refurb costs. So if you were doing a JV with someone, they'd put the money in, 6 to 12 months later, you'd give them all their money back. So they can now go and do another deal, maybe with you or somewhere else. And that's great. You know, you've got half a property which you wouldn't have had maybe if you'd hadn't had anyone to put the money in. Now let's say this is a good HMO, good 6-bed, it's making £1,000 a month profit. So you would share that typically with your joint venture partner. So they would get £500 a month and you would get £500 a month. So they're getting this cash flow, and also they might get 50% of the equity. So the mortgage, the mortgage is 210. The value is 300. So the equity in this property is £90,000. The difference between the mortgage and the value. So 90,000 split between two. That's £45,000 of equity that you have each. So what you're giving to someone is £45,000 of instant equity and £6,000 a year of cash flow. Now you're getting that as well, and I get the argument that you wouldn't have had that if they didn't put the money in, but I just want to be clear of how much you're actually giving away. Now in theory, the value of that property might well go up over time. You know, there's no guarantee that will happen, but because we live on an island with a limited amount of accommodation and an increasing population, over time, the value of properties go up. So if it's 300,000 now, in 10 years' time, that property could well be worth £600,000. So if it's 300 now, up to 600, that's an extra £300,000 of equity that you haven't had to work for. It's just happened because that's what's happened over time as values go up. So therefore, you're going to be giving them away an extra £150,000 of equity. So if you think about it, you're giving them 45k of equity up front, then over the time of growth, another 150k of equity. So you're giving away £195,000 of equity in this particular example. And you've given them that £6,000 a year cash flow. Well, over 10 years, that's £60,000. So by doing a joint venture where you were able to get all the money back to someone and then you shared the cash flow and the equity growth, in this example, this might have cost you £250,000 you've given away to someone, or the equivalent of £25,000 a year. £25,000 of profit you've given to someone just because you're doing joint ventures. So if you are doing joint ventures right now, I hope this is kind of ringing true to you and you're going to listen really carefully to what I'm going to talk about next about raising private finance, because this is going to save you an absolute fortune. And if you're new to investing and haven't done joint ventures yet, I don't want to put you off joint ventures. It might be a great place to start, but ultimately you want to be moving on to doing private loans, okay? It's very costly doing just joint ventures, okay? So a natural progression for you as you become more experienced is go from JVs into private loans. So let's look at the cost. If instead of doing that deal we just talked about as a joint venture, what's the cost of you doing it as a loan? Now let's say you had to borrow 110,000 and that's made up of the deposit, the closing costs, the refurb costs, etc. It might be slightly lesser, but let's just do it on £110,000. So how much will it cost you if you're going to borrow that money for 12 months? And theoretically, you buy the property, you do it up, you refinance it, might take a couple of months to that. So it should be within 12 months. But let's say it takes you 12 months of borrowing this money. How much is that going to cost you? Well, if you were to borrow it at 12%, it would be £13,200 at 12%. Now, I use 12% because that's a very high interest rate. But in the property world, if you meet people at network meetings or people who are in property, a very common figure that people pay is 1% a month, i.e. 12% a year. So some people pay more than that, and actually if you have a really good deal, it might be worth paying more than that. Some people pay a lot less than that. But I just want to help you understand, if you're speaking to other property investors who know about this kind of thing, that's a kind of return people want to get, okay? But if you think about it, that's pretty much equivalent to your first year of profit. You were going to make £1,000 a month, £12,000 in a year. So really, it's just a bit more than your first year. So in other words, if you were to borrow this money at 12%, just giving away your first year of income means after that, well, you get to keep 100% of the equity and 100% of the cash flow going forward. Even at 20%, now I'm not suggesting you borrow at that rate, but at 22%, it would cost you £22,000, which basically would be 2 years of cash flow. And after that, you would have the whole thing. But really, you should be borrowing at more like a 5% interest rate. Why? Because if you're borrowing from friends and family or work colleagues, people who don't understand property, if you offered them a 10 or 12% return, and this is a mistake I see investors make, they say, I'll give you 10%, your family and friends will say, hang on a minute, I can only get like 0.1% in the bank, and yet you telling me you can give me 10%, and it's almost too good to be true. And if you offer someone too much money and they think it's too good to be true, they will actually walk away saying, no, I'd rather not do it, even though you're trying to help them and give them a great return. So please write this down. First lesson, do not offer people a certain rate. What you need to do is ask them what rate they would like. Now, we've done a lot of research on this, and actually the average person, I mean, it might even be slightly less now. We got to an average figure of 4 to 5%, but that was when you could probably get 1% in the bank. Now you can get a lot less than 1% in the bank. I think 3 to 4% is a more realistic figure, that most people would be really happy if they could get that incredibly high return compared to what they're getting in the bank. So, you know, if you were getting it at 5%, it would cost you £5,500 per year, which is, you know, less than half your cash flow in the first year. So this is why, instead of giving away half the equity and half the cash flow, learning how to raise private finance is going to save you an absolute fortune moving forward. Those of you that are more experienced, you've done joint ventures, I want you to sit and think about how much it's costing you to be in that joint venture. And, you know, maybe at the time it was the right thing to do, but I want to change your thinking moving forward. There might be a better way. So how do you go about actually raising money? And the first thing is you need to change your thinking about this. One of the challenges, we're going to talk tomorrow about some things that block people from moving forward. One of the challenges I know is where people think, well, if I'm asking for money, I'm kind of like got my hands out like this, and I kind of feel a bit bad because I'm kind of asking someone for a handout. Oh, can you give me some money for my property investment? And people worry what people think about them. And in fact, I want you to all get your hands in front of you like this and just imagine what it feels like to ask someone for money. It's not a great feeling. But actually, if we just twist things slightly and cup your hands together and imagine that in front of you, your hands are full of golden coins, gold coins. And that gold coins are quite heavy, and they represent the profit that you can make from your property investing, the cash flow and the long-term equity growth. And instead of going to someone with empty hands, you're going to someone with your hands overflowing with gold coins. You say, look, who do you know who might want to share some of my profit? And so you're giving some profit to someone, and that's interest you're going to pay them. And that's coming from a place of opportunity. No longer am I coming from a place of lack. Can I have some money? It's, I've got a great opportunity for you to get a great return on your money. Are you interested? Kind of thing. And in fact, you never really ask anyone directly if they're interested, because even if they have money, no one's going to say, oh yeah, I've got some money, what's it for? Because they might feel that, you know, they might feel obligated to you. So instead of asking people, have they got money or would you like to lend? You say, who do you know who might want to get a great return on their money? Who do you know who might want to get a great return on their money? Who do you know who might want to share some of the profit from my property investing that I'm doing? And so it's all about knowing how to approach these people. The best people to approach are people around you, people who already know you and already trust you. Yes, you can go and find people at property investor network meetings and events like this. When we have live events, and hopefully if you're following what we're saying, if you're doing the networking and people can read your name clearly and you're in the group and you're telling people what you want, you might attract people here who eventually, once everyone's done their due diligence, might want to lend you money and work with you, okay? But the problem is those people need to get to know you and like you and trust you. People who are family and friends, they're far more likely to want to lend to you because they know that you're already a trustworthy person. Well, I'm assuming you are a trustworthy person, obviously. You need to speak to everybody you know. And it's important because sometimes we make assumptions. We might say, oh that person's not going to have any money. Or that person, they're not going to want to lend to me. We just don't know until we ask. The person you thought had no money, maybe they've just inherited some money. Maybe they've just been made redundant and got a redundancy. Maybe they've just had a divorce so they've got a settlement. Maybe they've just had an accident and got a big compensation claim. They've got some money sitting here. You really don't know what people have got in the bank. And that's because in this country, we don't really like to talk about it. It's kind of a bit secret, really. It's not seen as etiquette to talk about what you have. So that's why most people don't do it. You don't know who might have money in the bank. That's the point here. So don't judge or prejudge anybody. And if they do have money in the bank, they are literally losing money hand over fist every day, because the amount of interest they're getting in the bank is so small, it's a lot less than inflation. So if someone puts some money in the bank at the beginning of the year, and by the end of the year, they got a tiny, tiny, tiny amount of interest, and yet prices have gone up. So that money they put in the bank at the beginning of the year cannot buy as many goods and services at the end of the year than it could at the beginning of the year, because things have gone up in price. So inflation has eroded their money. So really, you want to be making at least an inflation return. Otherwise, your pot is going to get smaller and smaller. Same amount of money, but less buying power. So anyone who's got money in the bank right now really has a big issue. Now, many people are aware of this, but many people are not, because they don't know what else to do with the money. It's just sitting there. And you might think, surely everyone puts it into ISAs or bonds or shares. Well, no, they don't, because again, you're assuming that people are financially savvy. You're going to have someone who's really, really smart. Doesn't mean they're financially smart, because guess what? No one ever teaches us in school how to manage our money, how to be financially independent. Maybe they should teach that to us in schools, but unfortunately they don't. So you can help them while they are helping you. And that's the key here. It comes back to this win-win. You want to give them something that they want, and in return, they'll give you something that you want. You obviously have to be very careful when using other people's money. Be more careful with other people's money than you are with your own money. I've had situations where I've put money into a deal, it's gone wrong, I've had to take the loss, and I've given the person back all their money plus their profit, which I think is fair and ethical, and I've had to take the loss, because if I put it into something that hasn't worked, that's my responsibility. So you have to be very, very careful when using other people's money. I do hope you enjoyed watching this video. If you enjoyed it, I highly recommend some live online training that we're doing. All you have to do is click on the link below to get full details. And the great thing about live training is obviously we can interact, you can ask me questions, and we can answer them live in the moment. So come and click on that live online training. I look forward to you very soon. In the meantime, I've lined up another video I think you're going to find very useful. So invest with knowledge, invest with skill.